Very good afternoon, good morning. Welcome to the FX Week Ahead live market analysis with myself, Giles Coghlan. I do hope everybody is well. There are some important updates to share today, as well as a whole host of central bank meetings, Federal Reserve, Bank of England, Swiss National Bank. So there's an awful lot to cover. I want to get us really nailed into the narrative when we start, so we know exactly how to sort of pick our way through these volatile risk-off markets that we're seeing to start the session. I'm not expecting that to last, and I'll run through the reasons why. Now, just to make it clear as I go through different entries, exits, different instruments I'm looking at, none of this is trading advice, and the whole idea of this is look over my shoulders, someone with a professional trading background, and you see how I go about making trading decisions. It's not an invitation or offer to trade, it's just showing you how I'm making sense of current market conditions. We will be looking at the preview and plan for Thursday's ECB meeting on Wednesday. We'll also have a look at the Fed meeting. So come along on Wednesday, we'll look at the workshop and I'll show you exactly what I'm looking for and potential opportunities that I can see in markets. I can see a big one for silver right now, and that's really, we'll cover that during the day as well as looking at some of the other key issues. Some of the topics need to just be bumped down the list because there's some more important ones to cover today. So hope everybody is well. I'm glad you could join me and looking forward to making sense of things for us now. So without further ado, let's have a quick look at markets and see what we're looking at. Now, the big news is that SVB financial group. The idea that this collapse of the cryptocurrency bank could result in some contagion was what resulted in markets turning risk off on Friday. And if you just take a look at stock markets, you can see that stock markets fell lower on Friday on those concerns. Now, over the weekend, we have had news that the US is going to backstop that financial group. However,
just be aware of comments from Swiss regulators.
We have seen some negative sentiment to start the session, and you can see the VIX is really pushing high. Now, the VIX tells us what the level of puts there are in the S&P 500. When the VIX rises, that basically means that more and more traders are expecting and insuring against potential downside in stocks in the S&P 500. So when this rises, the S&P 500 falls. Okay, so falling VIX, the S&P 500 gains. Rising VIX, the S&P 500 falls. So you can see volatility pushing higher. US equity markets, you can see all of them pushing higher. Dow, S&P 500, NASDAQ. NASDAQ's not pushing as low as these other two because NASDAQ is much more rate sensitive. And we've seen rate expectations just reduce for the Fed because they're expected to be less hawkish on this signs of economic strain. Now, I'm expecting this to fade. Can I explain why? Just because the expectations are that this will be contained. This is not going to be a huge, there's not going to be contagion. But nevertheless, you can't insure against fear, and so a lot of investors are very afraid. That's why we're still seeing that downside. FTSE 100 moving into that sort of key support level. Very attractive area for buyers around here in the FTSE 100. Just that's very noteworthy. Now, looking at commodities, they are pressured lower. Copper, WTI, Brent crude. Why? They're pressured lower just simply because of the risk-off trading. Now, again, I'm not expecting these falls to last, a tentative long in oil at this level. It makes sense with stocks just underneath 71.50. Are looking for a move back up into that range. There is long-term demand expected to grow out of China. I have just bought in at these lows around this sort of 72, 60, 70-ish region. I'm managing it in a slightly different way, but if you wanted to take a long, it would be possible from these areas with the 70 stocks just below 71.50. It is more, speculative, as it were, but I'm not expecting this risk-off mood to last. SMB financial group is being backed up by the US. UK not seeing any signs of stress. Eurozone committee, they're not seeing any signs of stress. So this just seems to be a little bit of fear in markets that doesn't actually seem to be warranted. Bond yields pushing lower. Now notice that across the board. right? Why? Because markets are seeing looser financial conditions now. They're not seeing the conditions that are going to be so tight. Why? Because this is a sign of economic strain. This is what the Fed wants, right? This is tighter monetary policy. And seeing the strain in financial markets is in one sense, the Fed achieving their goal. The dollar continues to drop lower. This is on the yields, okay? So sometimes the dollar gains and risk off. But this isn't a risk-off market that's really totally tanking risk-off. So, or else we see dollar bids. So this dollar is responding to the fall in yields, right? And you can see yields dropping lower. So that's why dollar yen, dollar's falling lower, and I expect that, that sentiment to really sort of carry on. One to look at is silver. Silver could really outperform here, right? Now, what's happening is with 10-year yields dropping so quickly, that means that the real yield should also fall, okay? So if inflation expectations remain higher, right, then we'd expect the real yield to fall. So if real yields are falling, the dollar's falling, that should be absolutely rocket fuel for silver. So I went long silver this morning just on that principle. That was in line with the gold silver ratio. Now, when the gold silver ratio is high, that means silver is cheaper relative to gold. So high gold silver ratio, and then silver can really surge, right? You see that move here in silver from like 12 all the way up to like 28. Huge, more than 50%, 100% gain in silver back in 2020. It was a great trade. I took some of that and didn't take nearly as much as I could have done. Here we see again, look, gold silver ratio pushing up towards that 90 region. So there is good opportunities now for silver and gold to gain because real yields should be tanking. Now, if you just take a look, let me say S&P 500 moving a little bit lower. Yeah, let me show you the interest rate expectations. Look how these interest rate expectations, look how they've dropped so rapidly, right? So 1 week ago, the terminal rate for the Federal Reserve is supposed to be about 5.5%. Look, now they're expecting like, so if they got to a terminal rate of 5.5, then that would be like, 4 or 5 rate cuts. If they get a term, so now the short-term interest rate markets, what they see a 60% chance of no rate hike on Wednesday, right? That should cause yields to drop significantly lower. Inflation expectations remain elevated, so real yields will fall, the dollar will fall, and that should really support gold and silver. So that's why we are seeing gold and silver moving so much higher today. See gold, woo, silver, whoosh, right? That's all making sense. And if this move continues, then gold and silver continue to gain and gain and gain, and could really rocket higher. We saw that 20 region was good support for silver, and it's continuing to, it's up, 4% on the day. So huge gains in silver on this current sentiment. So definitely you can see, right, there's a definite market shift going on here. And if you don't understand anything, then at least you can understand this. Look, in just a few days, expectations for the Federal Reserve rates have just plummeted. Look at that. Now seeing, essentially, there's only like 40% chance of a 25 basis point rate hike. Whereas last week, it was, at one stage, it was more than 50-50, I think, for a 50 basis point rate hike. So we're seeing some big market pricing changes going on right now. And, there's no reason necessarily for stocks to keep falling at the moment. Everything should be backed up, and the reason that they aren't rising is just a lot of fear in the market. That should fade, okay? But it may not, but that should fade. But expectations are certainly shifting. Now, with all that said, let's start to take a look at what we can see coming up. Now, on Tuesday, that's when it gets interesting. Yeah, we've got some UK data that, if that comes in, if unemployment rate comes in 3.8% or higher, and we see average earnings drop, then watch out for moves in the euro pound. I'm not seeing that as a tradable opportunity. If it comes in, disinflationary, you'd expect that to send the euro pound higher at the moment. But it's a little bit tough because sometimes the market's been focusing on stagflationary outcomes for the UK. That's pulled back recently. So you'd expect good news to support the pound and bad news to not support the pound. If you see unemployment low, that's disinflationary. So unemployment low is inflationary, high employment is disinflationary. And with the average earnings, if average earnings comes in lower than expected, that's disinflationary. The big event to look on Tuesday is the US inflation data. Now, remember with US inflation data, if we see this coming in for the headline 6% or lower, and we see the core coming in, 0.2% or lower, then that should continue to weaken the dollar. Now, if inflation remains higher, then that can weirdly support gold or silver at the moment, because if inflation expectations are still solid but real yields are dropping, then that will keep real yields lower. So what you want to look for here, is the scenario where we see the inflation data a big surprise to the downside. So if this comes in, well below market expectations, then that should support silver upside. But also if it comes in on expectations, it should also support silver upside, as long as folks are expecting the Federal Reserve to be less aggressive. So watch out for that. Core inflation, if that comes in, 5.3% or lower, then that should weaken the dollar and that should support silver upside. So I'd be looking at silver or gold if this comes in lower than expected. We then got Fed's Bowman speaking, and that'll set the mood for Wednesday, retail sales. Again, we're expecting a cyclical reaction for retail sales. So if that's high and we see a big move to the upside in US retail sales, that should support the dollar higher. So I would look a big beat in the retail sales print. I'd look at a euro-US dollar downside. Apologies for the loud noise going past my house. Now, the retail sales year on year, if that comes in, say it comes in like 5.5% or higher, then that should support the dollar, because that will start to play into expectations that the Fed can maybe be a bit more aggressive. We see some of that dollar weakness unwind, and so you might see some euro-US dollar downside. That'll only be a short-term trading opportunity. The problem we're going to have now, is these data points. It's going to get quite confusing because of the rapidity of the recent repricing. So just got to watch out for that. It could get very choppy. So be aware, these are only short-term trading opportunities in the CPI data and the retail sales, because the main data is going to come from the FOMC decision that comes at 7 o'clock in the evening. So, please excuse me, I'm actually 1 week ahead of myself. The Fed's decision, I just remembered, is not until the 22nd of March. So we're not going to have the Fed's meeting. So that does change it a little bit, right? So it just means that we need to be aware that the retail sales and the CPI print will help impact the expectations of how aggressive the Federal Reserve will or won't be, right? So if we see high inflation and high retail sales, we'll see some of that dollar weakness that we've been seeing, we'll see it unwind. But I think there's almost an asymmetrical opportunity in silver, because if inflation is high then it means real yields just going to move lower as long as expectations are that the Fed will be less aggressive. So watch out for the Fed expectations, what the Fed's doing. If we think the Fed is going to be far less aggressive now, and the reason people think the Fed will be less aggressive now is because of the banking crisis with SVB, that the Federal Reserve won't want to hike interest rates aggressively as the US economy is like clearly showing signs of struggling. So that's what we need to look out for very, very carefully today. And tomorrow's core inflation print is the same narrative, but just keep an eye on how markets are reacting to that SVB print. You know, that's going to be very, very important. With the retail sales, if that's high, it should mean in theory the Fed can be more aggressive, but investors and traders will be more focused on the SVB story than retail sales. So even if you've got a strong retail sales, they may still see a less aggressive Fed anyway. So this is not as tradable now as it was due to the SVB crisis. Sorry for the slightly confusion about the date of the Fed meeting. Aussie employment data is a little bit more important, because if we see very strong Australian labour data, that will mean the RBA will be more likely to hike interest rates. They're very focused on labour data, and if you look at expectations for what we're expecting, markets are expecting a 91% chance of no change. So if the labour data is very strong, that will start to give a little bit of expectation that perhaps the RBA will need to be more aggressive. So the thing to look out for is if we see let me just get, where is it gone? If we see a strong print to the upside, then you might look for some Aussie New Zealand dollar upside. So if unemployment rate comes in very strong, like 3.5% or lower, if the full-time reading comes in, you know, positive, anything sort of above 50, 100,000, and if we see participation rate higher as well, then you'd expect a little bit of upside from the Aussie New Zealand dollar. That would be the potential trade to look at. But we would need to see a very strong reading, and it would need to be a strong beat across the board to give a bit of upside. The jobless claims, continuing jobless claims is carrying on, and that will be important for initial and continuing jobless claims about how aggressive the Fed will need to be. If this comes in higher than expected and we start to see more people making jobless claims and more people making initial jobless claims, so that's above 220 for the initial jobless claims and above 1680 for the continuing jobless claims, then that should result in more silver upside. So definitely watch out for that. ECB meeting on Thursday. We will cover that in depth nearer the time, but interesting because we're seeing a little bit of, you know, pricing changing here. Look at this. The current pricing is now, you know, almost 50% chance of no rate hikes, and that's down from like a 50 basis point rate hike that was expected just last week. So expectations are really, really, you know, getting skewed by what's going on in the markets right now. So I'm not going to look at that now because we'll need to come back on Thursday nearer the time and check that out. We're seeing such, you know, choppy markets right now due to that. Now, on Friday, we have inflation expectations. And again, that's going to be important in terms of how aggressive the Fed's perceived that it needs to be, right? If we get inflation expectations starting to rise, so say you have the 5-year coming in above 3%, and we have current conditions falling, and we see consumer expectations falling, and say you have the 5-year inflation expectations not above 2.9, but say they come in 2.9 or lower, and you have these conditions falling, then that should be supportive of silver upside. So I'll be looking at that very carefully, potentially for silver or gold longs. That seems the best opportunity. If we see 5-year inflation expectations if they're 2.8, and then these both miss, and the preliminary for March also drop, and we see it on consensus miss, that should be a good scalpel opportunity for like silver upside. So watch for that very carefully as we approach Friday. The key sort of narrative to focus on, so there's two things. One, just be aware that there's a lot of moving parts today. And if you see nothing else, see this. Look at the way the expectations have dropped for the Federal Reserve. They're now seen as starting to cut interest rates. They're seen almost about to pivot due to this SVB financial crisis. That's point number one. So that should result in stock upside. So these dips should find buyers on expectations of lower interest rates. The reason they're not is we've got fear in the market. So if and when the fear subsides, watch for this to, move sharply higher. That's the first point to be aware of. The second point to be aware of is gold and silver. Even since we've been on the webinar, you can just see that silver is just it's just continuing to rip higher and higher and higher. It's very extreme moves that we're seeing. So just be aware of that dynamic. It's because expectations are is that real yields are, when you get real yields falling and you get the dollar falling, when you get them moving together, then that's upside for silver and gold. So we're seeing gold and silver move up very, very sharply, which is kind of what we'd expect. But these are quite dynamic markets, so just be aware. Oil, I said, that's not a bad little area for a potential sort of more speculative long, right? Just stops underneath 71.50. That could see a little run up higher. A lot of Chinese demand expected for oil, and ultimately this all should be pretty good news for stocks once the fear fades, right? So if you want to try to see, look, how do I know if the fear? If you look at the VIX, if you start to see the VIX pull, turning over, it means the fear's fading. So that's what will give you an indication if the fear's fading. Just call up the VIX on TradingView and then look at it. And if you, do you see this is the S&P 500 overlay? Do you see? So when the VIX rises, the S&P 500 falls. Okay, falling VIX, rising S&P 500. Rising VIX, falling S&P 500. So all the VIX tells you is how many put options equity traders have in the S&P 500. That's what it tells you. So a put option is when you're expecting the underlying asset to fall. And so often, if there's a trader and they've got a lot of long S&P 500 positions, they'll increase their put options to offset against any falls. Right, so you're thinking, well, I don't want to close my long position. I keep my long position in, but I might just have a put option as well. So if it does fall lower, I can cash in on the falls, and that's what's going on here. So there's some traders, there's fear in the market, so they're putting put options in because they're not quite sure what the narrative is, not quite sure. Hang on, is this going to fade? Is it not going to fade? You can understand the reasons for caution, right? It's complicated markets. So that's what's going on. But if and when that fades, if you see the VIX roll over and start dropping, look below 28 and then 25, and that'll give you a good indication that we can start to see some potential buying in these areas. It may be a bit early just to buy into stocks, right? So just to be aware, we may still see some downside. Don't forget, on Tuesdays you tend to see something called a turnaround Tuesday. So it may be that Tuesday becomes a very good day for a turnaround of stocks, or it might turn around strongly in the second half of the US session. Okay, so just to be aware of that. All right. Yeah, there's also this news of First Republic. That bank's in trouble as well. So there's a number of there's a number of strains out there. So keep on top of the narratives as we go through the session. It's tricky markets today. Okay, so be careful out there. Not easy trading. So watch out for it as we go through, and we'll be back on Wednesday and we'll look at the ECB meeting and get ourselves completely ready for that. We won't look at it now because we want to see how these moving parts settle as we head into the end of the week. Okay, folks, take care. Thank you all very much, and we'll speak soon. Thanks everyone now. Goodbye.